In Asia business, higher U.S. tariffs are set to take a further toll on developing Asia this year as they threaten to sap the region's export momentum and growth. The Asian Development Bank has trimmed its growth forecast for the region this year to 4.8% from 4.9% just 5 months ago. The revision reflects downgrades in India and Southeast Asia, with growth prospects there weighed down by the impact of U.S. tariff hikes, tepid growth demand, as well as heightened trade uncertainty. While trade deals with Washington halved tariffs from April levels, the ADB said levies on several Asian economies are still particularly high. They range from 10% for 23 regional economies to as high as 50% for India. Additional sector tariffs, such as those on auto and auto parts, have hit South Korea the hardest. Cambodia, Vietnam, and Malaysia are also among Asian economies most exposed to the impact of sector-specific tariffs. But falling inflation will work in the region's favor. This is seen to pave the way for more fiscal stimulus and looser monetary policy, measures that the ADB expects will partially counter trade headwinds and support growth in developing Asia. Some Asian central banks have already begun to ease monetary conditions ahead of the U.S. Federal Reserve to blunt the impact of the Trump administration's tariffs. And they may soon find more room to cut rates now that the U.S. Central Bank has resumed its easing cycle. Now let's bring in Albert Park, Chief Economist with Asian Development Bank. Good morning to you, Albert. So when we talk about tariff shocks and supply chain disruptions, do large economies like China and India actually have a built-in advantage over smaller Asian economies, or can nimbleness beat scale?
Well, I think in terms of the current trade policy uncertainty that the world is facing, obviously, countries that are more export dependent on U.S. exports are more exposed to the shocks from the tariffs and the uncertainty. And also, countries that received higher tariff rates in their negotiated deals with the U.S. are also more vulnerable. In general, large economies tend to have larger domestic demand that they can rely on and are so less export reliant. And open, smaller economies that really rely on trade to be able to achieve economies of scale to produce and export are more dependent. And so we've seen that. The most important exporters in the region in Southeast Asia have been hit relatively hard by the tariffs. It differs, of course, from country to country, depending on the sectors that are exposed and how much of the exports is going to the U.S. But overall, I really want to emphasize that growth remains pretty resilient because, our downward adjustment of 0.1% for this year is in comparison to before Liberation Day tariffs were even announced. In other words, when the world was normal. And so the fact that growth is slowing only by 0.1%, I think, does reflect the resilience of the region and the competitiveness. It helps that many of the key exporting economies in the region got similar tariff rates of 15 to 20%. That creates less disruption of kind of moving from one country to the other because of huge differences. It also makes it harder, I think, for the U.S. to substitute the source of imports away from the region to other parts of the world because Asia remains really the source of such a big share of U.S. imports, 40% or so.
Mm-hmm. Well, Albert, and the report also mentions that inflation is cooling across much of Asia. So does that open the door to rate cuts, or are central banks still too wary to reigniting price pressures?
Well, as always, every country's circumstance is different, but we do expect to see more rate cuts among economies in the region. Already this year, there are 11 economies in Asia that have reduced policy rates. Most notably, India and Pakistan had fairly substantial reductions. But our projections really are that the inflationary pressure from commodity prices, in other words, oil, we expect the oil price, which is currently around $67, we expect it to lower to $57 next year, given increased supply and reduced demand. And rice prices in the region, which is the most important commodity, have been falling steadily. And last month reached record, really lows for the past 8 years or so. India had a very good harvest, is now returning to export markets. So given that context, we really strongly feel that inflation is going to continue easing in the region. And in combination with expectations that the U.S. also is going to be, the U.S. Fed is lowering interest rates, that's going to provide more room for central banks in the region to reduce their interest rates and help stimulate economic growth.
Well, Albert, if Asian central banks start easing while exports still remain weak under U.S. tariff pressure, can monetary policy be sufficient enough to cushion the blow? And what else are needed?
I think that the answer to that will depend on each economy. But, you know, most economies, they don't rely 100% on exports to the U.S. Most economies, that even the ones that are exporting, are exporting to multiple countries. So I think monetary policy can play a substantial role in cushioning the shocks. And, of course, targeted fiscal policies that really support the firms that are being most dislocated could also be an option for some countries if their budget resources enable it. I think resilience is still a good word to describe the opportunities to respond to the current challenging environment. And of course, we know economies are also trying to continue to diversify their export markets. China has been pretty successful in redirecting exports that decline to the U.S. and increasing them to other parts of the world. And I think that is an opportunity for many economies in the region as well.
We've seen some central banks across this part of the world starting to, step in to support their currencies. So should we expect more active currency defense across Asia as the U.S. dollar swings around?
Well, I don't think currency is the only objective of central banks. Obviously, their core mandate is still looking carefully at inflation and looking at growth. Right now, there is, some concerns about how fast inflation will go down and U.S. Fed policy, and also the export demand is a bit uncertain and maybe weakening. So most central banks need to kind of trade off all of these factors. We saw a lot of currencies in the region. We've seen dollar weakening this year, but it's stabilized in recent months. So I think it's at a decent level, but of course, central banks will have to continue monitoring that. More depreciation, or actually appreciation, if the U.S. dollar continues to weaken, then obviously this also provides more opportunity for the U.S. Fed for central banks in the region to lower their rates in response as well.
All right, Albert, thank you so much for your analysis. We were just talking to Albert Park, Chief Economist with Asian Development Bank.